Okay, so today I want to talk about the Save Market Savings 1-year term 8.26% APY account and what I think of it. Is this something that you should invest in? Is this a place where you should put your money? If you like content like this, please subscribe. It really helps for others to find this channel, and it helps me to reach my YouTube monetization goal. Okay, so what is this? What are my first thoughts? What are my first thoughts when I came to this website? I recently read this article today on Yahoo Finance, and this is how it got me to do this video. So it says here, Save launches first U.S. hedge fund-driven savings program. Save's global multi-strategy portfolio incorporates performance signals that aim to generate robust returns across market regimes in times of economic uncertainty, while customers' deposit remain FDIC insured. So right off the bat, I was interested because I know that the FDIC doesn't insure. They don't insure investments. So my scam radar kind of was going off, and then I started reading more. So it says here that Save, a fintech company, is helping people earn higher yields on spending and saving. Today announced new savings account portfolio with an absolute return strategy favored by hedge fund managers that seeks to generate steady positive returns in all market environments. The global multi-strategy portfolio has been designed in partnership with Second Foundation Partners, the publisher of Epsilon theory, and managers of global macro hedge fund that utilize their pioneering research. This research focuses on generating market-based returns by making trading decisions using natural language processing, by using natural language processing of financial news. These trading decisions are implemented via liquid ETFs seeking to generate returns across market regimes by 6 sub-strategies. Save, an SEC-registered investment advisor, expects the return potential of its market savings program on its innovative SaveTech platform to be higher than a traditional high-yield savings account. With our global multi-strategy, Save customers will have access to an investment strategy typically reserved for hedge funds and their clients. This portfolio will use performance signals for more robust outcomes, and we believe it will perform well over different types of market conditions. Save, an SEC-registered investment advisor, expects the return potential of its market savings program on its innovative SaveTech platform to be higher than traditional high-yield savings accounts, all while customer deposits remain FDIC insured. Okay, what is Epsilon theory? Because I've never heard of it. Okay, I believe Epsilon theory is a environmentally friendly way of investing where they invest in like solar and green technology stuff, but let's double check. I still haven't figured out what Epsilon theory is, but I think it has to do with environmental stuff because I see this guy like planting a birdhouse. It looks like he's messing with the birdhouse, and then I see this guy like petting a lamb. So I think it has to do with environmental stuff. Okay, I've read through a bunch of this stuff. There's no clear definition of what Epsilon theory, what the concept is. Like, there's no summary explaining what it is. So to me, it's just a bunch of gibberish. I've seen this company before, and my first thought was, this is what I've seen before with this company. I've looked at them several months ago, and several months ago they had this card that they were showing. This is called a Wealth Card. This was probably 3 months ago. It says average return of 5.67%. No variable categories, no exclusions, no cap on earnings. This is what I saw a few months ago. It says world's first high-yield credit card. Order my card. And it shows here there's 2 options available. There's a 5.67% credit card with no categories. So you're basically getting not just 2% on your money, but you're getting 5.67%. They have one here that's A plus, that's 3.78%, 3.78% annual average return, and then 5.67%. And this one has a $750 annual fee. This one has a $300. Now this is actually not, I thought this company was kind of scammy before, because I looked at this and it says here, this is average annual returns are based on hypothetical models. There's hypothetical performance is no guarantee of future performance. So basically this is hypothetical, can mean anywhere from 0 to 1,000%, 2,000%. So the only thing we know is that this number is completely made up, and this one's completely made up. So you don't know what you're actually going to get. It's not like a credit card where they pretty much guarantee that you're going to get 1.5% or 2%. So this is completely bogus, and this kind of rubbed me the wrong way. It's kind of a shady thing, and you've got to click here to find out that it's they could write possibly, or they could have written something next to it saying that that's just what they think you could make. Instead, you've got to click this little thing, and then they compare. Okay, so they're comparing their card to like regular credit cards that actually pay a specific amount. They're comparing their card, which has a hypothetical or a fictitious amount, to ones that actually generate real returns that are in writing. Of course, they can change it, but they're probably going to have to notify you if they make changes, whereas this one could change from day to day. So, and then it shows you that you could actually save, money. You could actually increase your returns. They'll increase your return by, let's say, 8%. If you use this card and you go to Apple or Samsung, they'll increase the return. So how does this actually work? Is they don't actually give you the cash back. They actually invest whatever money you spend. They'll put a certain amount of money into a investment account, and then they give you the returns from that investment. And that investment could be, you don't suffer the losses, but you'll get the gains if the portfolio goes up. But this isn't available yet, and that's another thing that I'll show you. This has been several months and it's still not available. So all this stuff is fake. It says order my card. We're launching our Plus and Premium credit cards. Order your card today to be the first to get your card as soon as they are produced. So they're not actually making this in the factory. There's nothing. This isn't available to actually sign up. I contacted customer service. I said, how many of these have actually been sent out? And she said, none. This is, it hasn't been launched yet. So they've been advertising this for like 3 months or so, at least that I know of, and they still haven't made these cards. You're basically signing up for a program that doesn't exist. This is not a credit card application. It simply reserves your wealth card for manufacturing. Now this is funny here. So it says here, this is not a credit card application. It simply reserves your card for manufacturing. So even this is sort of deceptive. They're making you think that they're actually going to make the card right now, but it actually isn't even ready to make the card. According to the customer service person I talked to, they haven't mailed out any cards, and it hasn't been launched yet. So they're kind of wasting your time right there. They're making it sound like you're just waiting to get it in the mail, when in reality this could be months, it could be years. You don't know. Okay, so how does this 1 year term, what do I think of this? I think just like their credit card, it's kind of deceptive. Just like their credit card, it's deceptive. Their credit card is not even available. They don't pay you what they say they're going to get. These numbers here, you're not going to get this. This is under the best case scenario, you would get this. So how does it work? And then also another thing that I want to get picky about, this is called market savings, right? This is basically a CD. There's huge penalties if you take the money out. This isn't a savings account. It's so, right? They're deceptive on the numbers, and they're deceptive with the naming. This should be called a CD. That would be the most similar. So how does it work? Okay, you sign up with this. If you sign up with the 1 year term, you put in, the minimum is $1,000. You give them $1,000. they put it into an FDIC insured bank account with Webster Bank, an FDIC insured bank. They deposit your $1,000 with Webster Bank. It sits in the account, in the FDIC insured account, and it's not touched. You can't touch it for a whole year or there's penalties. On the side, they open a brokerage account, and they'll put a matching. So if you put in 1,000 into the savings, if you put 1,000 into this account, that 1,000 will go to Webster Bank, where it sits uninvested. Save will automatically match another $1,000. They put it into a brokerage account, and they will invest that money with a basket of ETFs that they choose, or that you choose. And based on that return, they're estimating that you will get 8.26% a year. The only thing they're guaranteeing is that you will get 0% on your FDIC insured account. That's the only guarantee. So the only guarantee is that you're going to get 0. So you could get 0 on any bank account. Even probably the worst bank accounts, you're going to get 0. That would be no interest. That's the only thing they guarantee. This is all, fictitious or, pie in the sky scenario that you would possibly get this. And so you don't actually keep the principal from the $1,000 in the brokerage account. You only keep they will only give you the earnings on that. The same goes with the 2-year term and the 5-year term. Now these are basically, they could be invested in the same thing. So they're just estimating that in 5 years, the average annualized return would be 9.18%. But on a 1-year term, it's going to be and I'm guessing they're estimating 8.26% for 1 year versus 7.79% for the 2-year, is probably because the market has gone down, and they're probably looking back on history that when the market's gone down, 20 or 30%, it typically goes up the next year, or when it goes up, probably the next year it's going to be higher. And then the following year, it's actually a lower return than just a 1 year. It says here, you sign up, you deposit the money. They will open the account, a savings account at Webster Bank, FDIC insured account. And by the way, it's called they call this a savings account, but it's actually 0. This portion of your account is actually zero return. So maybe they're calling it a savings account. Maybe they actually make money on your savings account with Webster Bank. I'm not sure how that works, but maybe that's why they called it a savings account, because they're opening a savings account with Webster Bank. And they will open an investment account at Apex Clearing. And that the cash in that account is actually SPIC insured. You make the investments. We will make an investment in your selected portfolio. This investment will be held in your Apex account. The investment will mature after 1 year and 1 day, or up to 5 years. So after that point, if you want to take the money out, you can contact them, and it'll take 12 to 15 business days. It'll take 12 to 15 days after you want to take the money out from the 1 year or 5 years. You can check your investment performance by logging into the Save app. You can withdraw your deposit at any time, subject to a cost associated with yearly termination. Well, that's the only thing that I've actually seen this is the only thing I've seen that's sort of been honest. This is actually very clear. The other stuff is not so clear. After your investment term ends, you will receive your deposit back and the investment gains, if any, in your selected investment portfolio minus our fees. So the great thing about this account, according to Save, is that you're not going to lose any money. If you're worried about your money going down, you're not going to lose any money because it's in an FDIC insured account and that money is not touched. The term is limited to a 5-year investment term. Guaranteed rates, no. Well, I guess that is true to some level, that the rates aren't guaranteed, but when the rate changes, the bank will typically notify you, whereas this is changing on a daily basis with the Save account. They're not going to give you like a 3.8% fixed rate like my Wealthfront account and pay it, until they change it. Now they're comparing the 1-year term to FDIC insured accounts that actually pay real money. that pay real money. They're comparing fictitious results to real payments that are actually made by FDIC insured banks. And they don't stop there. Now you can see they're doing the same thing with the Wealth Card. So you can't do partial withdrawals. You have to withdraw the whole amount after the time period. Here if you click on the truth and savings disclosure, it shows here that it's a hybrid product, and that the savings account, the deposit account portion, is provided by Webster Bank and is non-interest bearing, 0% APY. That's the only guarantee, is that you're going to get zero. You're going to get at least zero. The variable APY, if any, is derived from investments made by Save on behalf of the customer with Save's portfolio of strategies over the duration of the term selected by the customer. Okay, this is their hypothetical backtesting, and anybody can do backtesting. I have another video that it's under that's called Composer, which is like a online trading bot type service, and you could basically do backtests for different things. This is the same sort of thing they're doing. The ESG one, this is basically sort of the green portfolio. Okay, you can see here that the maximum that they will invest is the iShares Treasury bond ETF up to 25%. There's a solar one, 10%, gold, 10%. Here's the conservative one. Okay, so they will do up to, the conservative one, they will do up to 25% Treasury bonds. Now you could actually build your own Save account based on this if you wanted to. You could buy these same ETFs. You could do the short-term corporate bond. You could do the corporate bond ETF. Small cap. The conservative one has a lot of ETFs. You could do the preferred and income securities ETF. This one has a dividend yield of 6%, I think. And then here you can see the back test that they did on this account. And what's kind of interesting about this here is you actually see that this hypothetical backtesting strategy, the annualized performance is only 3.4%. So maybe this is not the one that they expect to earn the 8-point-something%. Maybe it's one of the more aggressive growth. This one here says 2.35%. So this one is probably not the one that they're advertising for the 8. So let's find the one that they're advertising. Okay, here we have the market savings right here. Hypothetical backtested average return market savings. Okay, this one, the Save Growth portfolio. What is the return on this one? What do they expect it would make? Okay, so you have pretty much the same thing here. You've got treasuries, bonds, Vanguard large cap ETF 25%, Vanguard small cap 25%, dividend appreciation Vanguard. They have some gold, preferred and income. Okay, now this one, annualized performance, it says 3.91%. So it's still not 8 point. So they did their back test from 2006 to up to 2022 of January. That was kind of the peak of the market. Maybe that's why they expected it was going to make 8%. January 2018 and 2013. This one also says 2.62%. Now here's a Save strategy linked. They charge a fee of 0.35%. Okay, now this one they're actually showing 9.18%. Okay, it looks like maybe they're breaking these up. They're breaking these up into 3 sections. That's why, and then doing returns for each. Oh no, they have them all here. Group 1. They have group 1 through group 3. They're all in here. So this one, okay, they broke this one down by ticker. You see that they're invested in VGT. That is actually Vanguard Information Technology. VWO, I believe that's emerging markets. Vanguard. Junk, this is a junk bond portfolio. This is a high yield junk bonds. Gold, that's gold. AGG. This seems to be the largest one. So AGG is the iShares Core US Aggregate Bond ETF. It has a low expense ratio of 0.03% and a yield of 2.39%. And if we look at the chart here, you can see that over this, it hasn't gone up or down too much. That's the one where they have the most amount of money, it looks like. They've got like 6%. So I've looked all over to try to find where they get the 8.27%, and I can't find it anywhere in the backtest. So if you actually go, this is another place you can look. If you, rather than looking at the backtest results, if you just scroll down here to where it says Global Diversified Markets ESG Portfolio Global Multi-Strategy, and you click on each of these, you can see they did a backtest here, and it shows the percentage of observations. This is 1 year return. So you see that this one, it looks like mostly, it'd probably be like this 3 to 4.5%. So this one is definitely not the 8% one. And now it looks like they have different versions of this. They have conservative, moderate, and growth. So let's look at each of these before I give up on it completely. This one here is 1.5 to 3%. It's definitely not 8. So let's look at growth. Nope, it's not 7.5 to 9. It looks like 3 to 4.5%. Now let's go to ESG portfolio. This one looks like maybe 4 to, well, actually 0, less than 0 is more common. Look at that one. Less than 0. The number of observations. So that's the most likely scenario. And then if we go to the last one, global multi-strategy, there's only one option for that. Okay, this one looks closer to it, but it's still not the same. It's 6 to 7.5%. They picked, something here, but that's not the most likely scenario according to this. Here you can see the asset allocation for each. Bonds, equities, treasuries. Here's the tree hugger one. U.S. treasuries, bonds, commodities, international. Okay, let's do the last one. This is the one, I think it's the newest one. It's supposed to be like hedge funds. Look at this one. Currencies, 39.6%. Bonds, relative value, equity. Oh, I did find the address. Here's the address right here. I did find the address. I found the address in the investment documents. So it says Houston, Texas. Okay, how does Save make money? They charge a management fee on the market savings account. It's 0.35%, but that's only if it earns more than 0.35% before they take their fee. So if it earns 0.34%, if it earns 0.35% only, they're not going to charge you a fee. They charge over that amount. So it shows here, portfolio earns less than 0.35. Save charges no fee. Portfolio earns exactly 0.35. Save charges no fee. Portfolio earns more than 0.35%. You collect all earnings above 0.35%. So that's with the savings account. Now with the credit card account, the credit card account's not open yet. But they have I think it's a 0.79 fee on that if they ever open it. Okay, what are the costs for early withdrawal? The fees are pretty hefty, so they call this a wrap fee. Early withdrawal, let's see here. Fed funds rate, which is, I believe, 4.3 plus 50 basis points. The wrap fee, they charge you the 0.35%. I believe this may be for... One of these may be for the longer term, and then the other one may be for the shorter term. But you can see there's quite a few. I don't quite understand this, but there's quite a. It looks like there's quite a bit of fees for early withdrawal. Okay, so what's my conclusion of Save? Would I put my money there? Would I put my money in Save? The answer is no, and I worked really hard to try to make it work. And I did a lot of work to make it work because they were offering, it looked like a pretty good bonus to refer people, and then I would get a referral also. But it just it's a little bit too shady for me to do. looking at their past history, I don't trust that they'll actually pay out anything. I don't want to get any backlash if something goes wrong. So I've just decided to not put my own money there and to not do any referrals or any of that until at some point maybe they'll get their act together and I'll be promoting them and I'll be able to say, yeah, I'm going to put my money there. It's okay. But right now it's too risky for me and too uncertain. So what are my reasons for making this decision? So I'll just kind of do a summary here. There's a lot of deceptiveness that I didn't like the naming of their account savings when it really should be CD. That's a little bit deceptive right there. The rate is deceptive. That's a big one on both of their products. Their rate comparing their rate to credit cards and their rate to bank accounts that are completely different, that's a little bit deceptive. Not being able to find the backtest value for the 8.27%, that's kind of a shady thing there. The credit card option is deceptive because it's not available. The credit card order form is also deceptive because they make it look like they're going to print the card and mail it to you when in fact there's no date or anything. There's also a debit card that they had. That's another thing I didn't even mention. They had a debit card back last year that was basically the same thing as this credit card. Okay, here you can see the debit card. They ended the debit card program, and somebody asked, why is the Debit Invest program ending? We are upgrading our product range and we'll be discontinuing the Debit Invest program to better serve you. So they completely dodged the answer to that question. I mean, we will discontinue all Debit Invest cards and associated checking accounts on July 1st, 2022 to serve you better through our newly launched high yield premium and plus wealth cards. Okay, so that wasn't even available and it's still not available. So they closed down their debit card and they're saying it's so they can move people over to the wealth cards when they're not even available. And it's still not available. And market savings program. So to me, that answer is not acceptable. I mean, if the debit card was shut down because they were losing money, at least they could be honest about it. Businesses fail all the time. It's how they handle it. Are they going to be honest about it? Because I could handle that a little bit. That makes me concerned. If this debit card program failed, it seems to me that if this credit card program opens, it could also fail. Maybe it's just a bad business model. Okay, there's another one. There's no phone number that I could easily find. I mean, there is a phone number that if you dig really, really deep, it says for customers. You can find it, and I really couldn't find the address at all until I looked at one of the documents. So that I don't have a whole lot of trust with that. There's a Trustpilot website, and there's 1 rating. That's it, 1. Not enough ratings to actually make a decision. There's no protection in place. It's not an FDIC insured bank or SPIC insured brokerage. So you're basically, everything about this company is about trust. It's like FTX. I mean, basically they had no protections in place and it was all about trust. And if you can't trust, based on all those things I mentioned, if you can't trust them, it's possible that they could just take your money, put it in their own account and never actually send it to the FDIC insured account or say that it was lost. You never know what's happening behind the scenes. So that's why I'm not going to put my money into their accounts. That's why I'm not going to invest with Save. So I hope you liked this video today. Press that subscribe button so you get notified of new content. It also helps me to reach my YouTube monetization goal. Anyways, have a good one.